This video will discuss liquidity ratios. Ratio analysis is yet another tool that can be used to interpret and analyze financial reports. The different types of ratios evaluate different aspects of a corporation's operational results and financial position. Liquidity and efficiency ratios measure the company's ability and liquidity and efficiency ratios help creditors and other interested parties evaluate the company's ability to pay debt as it becomes due. Working capital is the amount of current assets less current liabilities. A company needs adequate working capital to meet current debts, to carry sufficient inventories, and to take advantage of cash discounts. The current ratio, calculated current assets divided by current liabilities, measures the short-term debt paying ability of the company. The acid test ratio, quick assets divided by current liabilities. This ratio is like the current ratio, but it excludes current assets such as inventories and prepaid expenses that may take time to convert into cash or may expire over time and not be converted into cash at all. So this really focuses on liquid assets, cash, short-term investments, and current receivables. The accounts receivable turnover ratio, calculated net sales divided by average accounts receivable net of the allowance for doubtful accounts. This ratio measures how many times a company converts its receivables into cash each year. Inventory turnover, cost of goods sold, divided by the average amount of inventory, measures the number of times merchandise is sold and replaced during the year. Days sales uncollected, accounts receivable net of the uncollectible allowance account divided by net sales, measures the liquidity of receivables or how long on average before receivables are collected from customers. Days sales in inventory, ending balance in inventory divided by cost of goods sold multiplied by 365 days, measures the liquidity of inventory, how long inventory is on hand from time of purchase to date of sale. Total asset turnover, net sales divided by average total assets, measures the efficiency of assets in producing sales. Calculation of the ratios is only the first step in financial ratio analysis. Once those ratios are calculated, they need to be compared. They need to be compared to the same ratio for the company in prior year, compared to the ratio results for a competitor or to the industry. These ratios mean nothing until they are actually compared to identify whether the ratios are indicating good results or a cause for concern.